Hello, this is Chad Staskell, President of Ego Wealth Management. I'm happy to be here with you to share our 2017 State of the Markets PowerPoint presentation with you. I understand many of you are not able to join us at our in-person presentations, so I hope this recorded version allows you to get some of your questions answered on our views of the economy. Your personal financial plan is our #1 priority, and helping you focus on your economy and the things that you can control is where we like to spend our time in our personal meetings. This presentation will focus more on the economy and the areas that we cannot control. These areas do influence some of the decisions we make, and we hope to have you have a better understanding of how we are navigating our markets. As always, we do need to share disclosures with you to keep our regulators and attorneys happy. Obviously, this presentation includes many facts and some of our opinions. We always do our best to give you the most accurate representations of the economy that we can. The financial world, it's incredibly complex. And these days, we're all bombarded with dramatic headlines and contrasting opinions. So, our goal today is to educate you about some of the factors we and the expert financial analysts are watching. Of course, it would be impossible for us to cover everything, but we will try to touch on some of the most relevant factors. And while past performance provides no guarantee of future results, we will focus on the trends that may help guide the decision-making process when investing. Here's what we're going to talk about today. What happened in 2016? What factors affected the markets? What's on the horizon? And what do financial experts forecast for 2017? So let's start off by talking about how to put last year's stock performance into perspective. We were coming off a year when all major domestic indexes lost a small amount of ground in 2015. So, when we started 2016 with fears about China's economy and the Chinese Shanghai Index dropping 6.9% on the first trading day, the U.S. markets experienced their worst ever start to a year. By February, markets hit their bottom and started rebounding in response to GDP revisions. Also, consumer spending improvements helped. Growth continued at a relatively solid, but certainly not blistering pace before 2016's first major political surprise rocked them on June 23rd. Some of you may have heard it, Brexit. Few expected the Leave group to prevail and the UK to vote on support of exiting the European Union, but the Leave group did win. For 4 days, the global markets reacted strongly to the shock before stabilizing once again. But 2016 still has some curveballs in store for us. After one of the most divisive, hotly contested presidential elections in memory, the U.S. experienced two big surprises. Number one, Donald Trump won the election. Number two, markets responded with near glee. It launched a rally that would carry us through most of the year end. Ultimately, the year ended with all major domestic indexes posting sizable gains, far from the doom and gloom that greeted us in January of 2016. Despite experiencing a tough start to 2016, many of Wall Street's top analysts were still predicting a positive year for returns. While an average growth of 7.27% for the S&P might have seemed hard to imagine when we shared these predictions with you last year, the S&P actually beat the expectations. In fact, we ended 2016 up 9.5% for the year. And the S&P wasn't the only domestic index that performed well. The Nasdaq gained 7.5% and the Dow Jones Industrial Average added over 13%. Now, let's take a moment and let's look at some individual sectors within the S&P 500. The first chart shows sector performance for the first half of 2016. The second chart shows the sector performance for the second half of 2016. Do you notice any interesting patterns? For instance, let's look at financials, which was the bottom performing sector during the first half of the year. It lost over 3% in the first 6 months. Fast forward to the second half of 2016, and financials became the best performing sector in the S&P 500 with over 26% growth. Information technology was the second worst performer at the beginning of the year and was the second best by year's end. Utilities, on the other hand, had the exact opposite experience. It went from being the second best performer through June to the second worst performer July through December. What do these dramatic reversals tell us? Diversification is key, and knee-jerk reactions could cost you dearly. Investing involves risk and loss, including possible loss of principal. No investment strategy can guarantee positive results, but diversification can help. So we've seen that 2016 was quite an eventful year in the world and in the markets. But let's dig deeper into some of the factors that contributed into the market and the economic performance last year. Here are a few that we're going to discuss today: the labor market, manufacturing, oil and natural gas production, business investing, global growth, inflation, and interest rate increases. In many ways, 2016 was a good year for American workers. We experienced our 75th straight month of job growth. Unemployment dropped to 4.7%, less than half of its peak during the Great Recession. And we're finally seeing labor markets tighten and more people return to work and earn more money. While higher wages can affect corporate profits, they do drive consumer spending, which accounts for more than 2/3 of our GDP. We do hear a lot of bad press about U.S. manufacturing, but the reality is different when you look more closely at the data. As you can see from this first chart, manufacturing output is going up and has continually gone up since 1970. Another way to think about manufacturing, as well as oil and gas production, is to consider the economic value they create as compared to global GDPs. As you look at the value of U.S. manufacturing production, it would represent the 10th largest GDP in the world, bigger than India, Canada, and Australia. And U.S. oil and gas would be the 17th largest economy. In some ways, 2016 was a tough year for oil. In February, crude oil bottomed out at $26 a gallon, a fraction of its peak at over $147 a gallon in July of 2008. At its most basic, there was simply too much oil in the market, which drove prices down. But by year's end, oil completed its biggest annual gain since 2009, thanks in large part to OPEC pledging to cut production in 2017. But at the same time, U.S. oil production is improving. While the cost of producing oil drops, it appears that energy companies are ready to expand what we are producing domestically. In 2016, oil mergers and acquisitions activity more than doubled in 2015. We're still not back up to 2014 levels, but we take this as a good sign that oil and natural gas industries are primed to grow once again. For years, as U.S. oil and natural gas production has increased, we have been closing the gap between U.S. oil exports and imports. And although the gap may have widened momentarily while oil prices dropped in 2016, we are moving closer to oil independence. In fact, if you hadn't heard, on December 31st, 2015, the Theo T tanker left Texas loaded with what may be the first U.S. crude oil export in more than 40 years. Then, in February, the Asia Vision tanker departed with its first cargo that left with U.S. liquefied natural gas. As we discussed earlier in the presentation, fears about China's economy were largely responsible for the market volatility early in 2016. Add concerns about Brexit, further disruption in the Eurozone and beyond, and you may start to wonder what's really happening with our global economy. Of course, global growth still has a number of headwinds, and you really must evaluate markets on a case-by-case basis. But I think this chart does a real good job of showing that global growth is picking up. This Purchasing Managers Index is a heat map that measures growth and contraction in manufacturing. Red indicates contraction or shrinking, while green indicates growth. If you can scan quickly, you will see that in January 2015 column, the more orange and red than it is in December 2016 column. Look deeper, and you'll see positive progress for the US, UK, Russia, Taiwan, and even China. In other words, this data shows us that global growth is picking up rather than threatening to decline. Let's talk about inflationary trends for a moment. Inflation is a general rise in the price of goods and services, and it's one of the key indicators of economic well-being. Though the relationship between inflation and the stock market is complex, generally speaking, stable, modest inflation is much better for equities than high or volatile inflation. If you take a look at the box in the middle of this chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts out this data and tracks price trends in a large number of goods bought and sold in the United States. The core CPI below it strips out volatile food and fuel prices to focus on long-term inflation trends. You can see that the light blue CPI line jumps around much more than the darker gray core CPI line. That's because food and energy prices tend to be more volatile in the short run. Though the past doesn't always reflect the future, historically, a sudden run-up in prices that often precede or accompany a recession. Note the huge inflationary spikes during the 70s oil crisis and the 80s recession. As of November 2016, the headline CPI of 1.7% was well below the 50-year average, and very close to the Federal Reserve's 2% benchmark. The Fed has a mandate to foster maximum employment and price stability, and they believe 2% rate can help support accurate financial forecasting and decisions while preventing harmful deflation. Okay, so we've looked at some of the factors affecting market performance for 2017. Let's examine what headwinds and tailwinds could affect the speed and trajectory of the economic growth in the near future. The next year and our new presidential administration bring many questions about what the future may hold. We could find faster growth, better jobs, increased oil production, and more if these three factors happen. The stock market performs well, business continues to invest in the U.S., and President Trump's policies accelerate the economy. In this case, we imagine future headlines touting major accomplishments a few years from now that could look like this. On the other hand, if some of the potential risks and headwinds we find catch hold of our economy, we may find a very different view 5 years from now. Here are a few policies we are watching that could be on the horizon depending on how policymakers choose to move forward. Ultimately, no one can predict the future, and 2017 brings a noteworthy amount of political uncertainty. We believe that to avoid emotional reactions during times like these, we must focus on the fundamentals. Look at what's really happened in the economy and analyze the data, what the data is showing us. Whether real or imagined, headlines are only helpful if we take the time to think critically and look at the truth amid the hype. So if we're facing uncertainty along with positive opportunities, do you have to worry about 2017 recession? Back in January of 2016, we went through these same slides, and this was some of the most powerful markers to look at and keep people invested, even though we saw the market sell off over 11% in the first month and a half of 2016. So let's take a look now at 2017. Let's look back first at this data in early 2008. Here we see a group of 20 indicators that help forecast what pressures will be acting on the economy and financial markets in the next 3 to 6 months after the report. Green is a positive for the economy. We call that a tailwind pushing economic growth along. Yellow is a caution, and red, it's a headwind. It acts like a brake on economic growth. The dotted line shows where the indicator was in a previous report, while the full line shows the current reading. Here we are in January 2008, about 8 months before Lehman Brothers collapsed in September. You can see a fair number of yellow and red indicators, long before the recession actually started. The economic outlook was negative, energy prices were rising, and the housing market was a red flag. Fast forward to December 2008, the red emerges on the board. The economy was in serious trouble. The housing market was deep in the red, volatility was high, and global economic outlook was negative. Business spending was dropping, and things were not looking very good. So what does it look like today? Here we are in December 2016, the most recent update of these indicators. You see a lot more green on this board. The U.S. economic outlook was strong. Consumer confidence is growing, business spending is on the rise, and many more indicators are showing positive signs. The only red on the board came from, you guessed it, the political environment. Given the uncertainty about how our new presidential administration will govern and what policies will come to fruition, this concern seems fair, and one for which we'll have more answers later this year. The yellow gauges are some areas where analysts have some concerns, and we will continue to watch for developments, especially over the next 3 to 6 months. So we can see that the global economic outlook and geopolitical risk both appear to be improving. The picture isn't perfect, but compared to 2008, I think you can see the difference in our economy's strength and potential. Now, the past can't predict the future, and financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're pretty confident we won't see a recession this year. The markets have rallied since the presidential election, reaching one record high after another, but are investors too euphoric? Are equities overvalued? When we look at this slide's data, we'll see that the markets appear to be at a fair value. There's a lot going on in this chart, but let's dissect what it's telling us. First of all, price to earning ratio, or PE ratio, means the difference between a company's price per share, or P, and its earnings per share, or E. The higher the PE ratio, the greater the difference between what investors pay for a stock and what the company actually earns. So a high PE ratio means stocks are relatively expensive compared to what their earnings are per share. If you look at the middle dotted line on the chart, you'll see that there's an average PE ratio of 15.9 times. In other words, over the past 25 years, stocks have averaged an average per price share of 15.9 times their earnings per share. In the Great Recession, the PE ratio was far below this average line, whereas it was high above the average during the dot-com bubble. For 2016, we ended at 16.9 times, nominally above the 25-year average, but still well within the one standard deviation above average. This data tells us that we do not appear to be in a bubble, and instead, stocks are currently at fair prices for their earnings, even though it may be a little higher than average. Perhaps one reason for consumers' rising confidence is that personal finances are improving. The percentage of debt payments people make compared to their disposable income has dropped, and the average household net worth has risen. We have seen a rise in serious delinquencies on auto loans and student loans, but total serious delinquencies have dropped significantly in the past several years. Overall, with rising wages, lower unemployment, and increasing net worth, outcomes are looking up for the average consumer. So after 2016's numerous surprises and ultimate solid performance across domestic indexes, we look forward to seeing what lies ahead in 2017. As we have discussed, we see many positive signs mixed with some uncertainty and headwinds to pay attention to. Let's look further at what we may experience this year. As we discussed earlier, inflation is currently at 2.1%, but what will happen in 2017? If you look at this chart, you can see that expectations for inflation jumped immediately following the presidential election. If President Trump is able to lower corporate taxes, increase infrastructure spending, and loosen regulations, or just one or two of these goals, there's a good chance the economy will speed up and inflation will rise. But even if inflation does rise in 2017, we don't expect it to reach uncomfortable levels. And the Federal Reserve still has a lot of room to adjust interest rates to help control inflation. The Federal Reserve seems to share our view the economy and inflation may both grow in 2017. After raising interest rates in December 2016, only the second increase in 10 years, Fed Chairwoman Janet Yellen said, "My colleagues and I are recognizing the considerable progress the economy has made. We expect the economy will continue to perform well. The Fed also said they may introduce 3 additional interest rate increases in 2017, up from their previous prediction of 2 raises. Ultimately, raising interest rates is a sign the economy is doing well. But what happens when interest rates rise? Let's take a look at this chart. The green dotted line represents 5% yield on a 10-year Treasury note. If you look at the placement of the tan diamonds, you'll see they're mostly clustered in the upper left and lower right quadrants. What this arrangement is showing us is that when rates are below 5%, equities tend to grow with rate increases. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, considering where we are right now with rates at 10-year Treasuries at 2.4%, history shows us that we may be able to expect the markets to rise as rates increase, as long as they stay below 5%. One area of the market that may stumble when inflation and interest rates rise is fixed income. On the last slide, where we saw the correlation between rising interest rates and a rising stock market, the data also shows a scenario can cause bond yields to rise too. While on first glance, increasing yields might seem like a positive scenario, yields and price have an inverse relationship. So generally, the more yield a bond provides, the less it's worth. After experiencing years of low interest rates, many investors may be surprised to see that their bonds can lose money. But a changing tide in the economy doesn't mean you have to abandon fixed income, because it often is an important part of a well-balanced, diversified portfolio that can provide the income investors need. Instead, you should pay closer attention to what bond risks and opportunities exist, and closely watch inflation and interest rates in 2017. We will also continue to monitor the geopolitical uncertainty that can significantly affect fixed income yields. After the December 2016 meeting, the Fed released its predictions for GDP. Unemployment in 2017 and 2018, as you can see, they predict that GDP will continue its steady, moderate growth, and unemployment will drop even further to 4.5%. Data from Wall Street Journal survey of economists echoes these predictions. And while we see growth, we still see they are lower than the historical average we've seen over the last 30 years. The good news for workers is that if unemployment continues to fall in 2017, then wages should rise in response. As you can see on this chart, where the gray line is unemployment and the yellowish line is wage growth, these two measures usually inversely relate. So when unemployment goes up, people can expect to earn more because there's less people to do the work. So, giving all these other predictions, what are the experts forecasting for domestic equities in 2017? Each year, various media outlets compile their S&P 500 price targets of Wall Street's top analysts. Let's take a look at what they have to say about the S&P 500 for 2017. Now, these targets aren't ours. They are what the experts are predicting. And as you can see, the 2017 estimates cover a 200-point range, from 2,300 from several analysts to 2,500 at RBC, proof that even experts often have differing opinions. But while they can have a range of results, one trend is consistent. Each analyst predicted that the S&P 500 will continue to rise in 2017. The average, 2359, is 4% growth. Decent returns, but less than half of the 9.5% growth we saw in 2016. Of course, as we stated earlier in the presentation, we're not trying to foretell the future. No one knows for sure what equities will do in 2017, and predictions at this stage are pretty foggy. However, these 12 analysts' perspectives show optimism continues on Wall Street. Alright, we've gone over a lot today. But if you remember just one detail from our presentation, I hope it's this: emotions have no place in investing. Over the past 8 years, we have weathered many storms, from the Great Recession to global pandemics to terrorism and beyond. And after all these tests and all the volatility, the market continues to grow and create new opportunities for you. As you can see on this chart of stock performance since 1980, the average year has a 14.2% difference between its peak and its low prices. That's a big spread, one that we understand can feel quite unsettling in the moment, but even with these intra-year drops, the market has been positive in 28 out of the last 37 years. Last year started terribly, and imagine what would happen if you let fear dictate your response, rather than logic and professional support. You could have missed out on an opportunity to grow your wealth and pursue the future you desire. We expect 2007 to bring an improving economy, but there is also real potential for volatility. So if you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you, and we want to help you make the most of your financial life. So what can you do in 2017 to move towards your family's goals? Here are some action items for you. If something changes in your life or a personal situation, keep us in the loop. We want to hear about the important family events. We also want to know about health issues, employment changes, and any financial development that could change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so we can help you pursue those desires that you most want. On top of specific financial life adjustments, we also want to know if you experience any changes in your feelings about risk or if you have any concerns about the market environment. We're here to talk through whatever financial questions, worries, or excitement you may have, so we can help you make informed choices and stay on track toward your goals. Throughout 2017, we're going to focus on delivering the following action steps to you. Keep you informed through regular communication. Along with our personal meetings and teleconferences, we're making sure to send out regular communication, including the weekly market updates, monthly economic updates videos, and semi-annual market and economic overviews. We're helping you with managing your investments according to your personalized strategy, and we want to stay on top of all the changes in the market environment and make prudent adjustments when necessary. We have gone through so much information here. You may have questions on something that was covered in this presentation or possibly on some other topic that you have seen in the news or read about. Please feel free to reach out to us and let us know. We're happy to answer any questions you have to the best of our ability. Thanks so much for your time. As you can tell, I'm passionate about helping you understand the markets and finding facts amidst all the hype. So for more information and timely updates, please feel free to contact us anytime. This is Chad Stayskull, President of Eagle Wealth Management, signing off for the State of the Markets 2017.